here for Chapter 3. We'll talk about what adjusting is, what that means. We'll learn about journalizing those. We'll summarize the adjusting process, talk about the trial balance, and then use some vertical analysis to talk about how we evaluate the financial position of a company. Let's talk first about the adjusting process and just what that means. First of all, we need to learn about what the accounting period concept is. And basically this means we stop and we measure. Accountants like to stop and measure how we've done over a certain amount of time. And so it says here it requires that revenues and expenses be reported in the proper period. Okay, so we stop, we measure, and say what revenues were there and what expenses did we incur to support those revenues, to earn those revenues during a specific period of time. The nature of the process of adjusting, it says that we use the accrual basis of accounting, that revenues are reported on the income statement in the period in which they are earned. So we focus on the earnings process, which basically means I'm a business, I delivered a good or a service to a customer who wanted me to deliver that good or service to him or her, and once that's done, typically I have completed the revenue process, even if I haven't been paid yet. So we focus on when the revenue was earned over when cash was received. Okay. So it says the revenue recognition concept is basically focusing on when revenues were earned, regardless of when the cash part of it happened. So we focus on the earnings process as opposed to the cash collection process. It says the accounting concept is reporting revenues and related expenses in the same period. It's called the matching concept or the matching principle. And so matching just means for every revenue earned during an accounting period, we also have some kind of expense also. Okay, so revenues earned to expenses incurred in the same accounting period. Under the cash basis of accounting, it says we only focus on revenues when cash is received or expenses when cash is paid. So if I was doing the cash basis of accounting, what that would mean is I only call something revenue when I receive the cash, and I only call something an expense when I pay the cash. Under accrual basis, which is the matching concept, I focus more on when did I earn a revenue and when did I incur an expense, regardless of when the cash has happened. Now individuals, me and you as individuals, probably focus more on the cash basis. You know, just think, it's payday, let's just say it's the last day of the month, it's payday. That's my revenue, and then I'm going to start to pay bills because we're all alive and breathing, therefore we've got bills to pay. So I've got my revenues less my expenses, and that's really more the cash basis, how that works. The adjusting process itself, it says under the accrual basis, some of the accounts need updating at the end of an accounting period for the following reasons. So basically we do our accounting, we do daily transactions, we're making journal entries and those kinds of things. And then we get to the end of the accounting period, and that's kind of when we step back and we go, okay, have we recorded every revenue earned? And have we recorded every expense that we incurred? And we have to ask ourselves that, and the answer is no, which it typically will be. That's our signal then to make some journal entries to fix that. So it says some expenses are not recorded daily, which several are not. Some are maybe just done monthly. Some revenues and expenses are incurred as time passes rather than as separate transactions. And some revenues and expenses may go unrecorded, that we have to record them to make sure we reflect them in our accounting records. So the adjusting process, it just says the analysis and updating of the accounts at the end of an accounting period is called the adjusting process. So it's not too difficult, just the process we go through to update the accounts. The journal entries that bring the accounts up to date are just simply called adjusting entries. So it's very simple, adjusting entries. There's a few kinds of them that we'll talk about. So here it says types of accounts that require adjustment. It says that prepaid expenses are simply the advance payment of future expenses that are recorded as assets when cash is paid. And so just imagine that you prepaid for something. Now, as individuals, we probably don't do that a whole lot, but actually businesses are quite often required to do that. I've been the CFO of a property management company, and we were required to prepay our rent for the full year, or not rent, our insurance for a full year. So when we bought our insurance policies annually, that was for the full year, and the insurance companies we bought those from expected full payment up front. And so it's not unusual to have to do that on a business level. Okay, so prepaid expenses, the advance payment of something for future expenses. So I'm giving up cash now for several months worth of expenses. And so an example of that here, it says transaction cash is paid in advance for an expense. And so the concept here is to debit an asset called prepaid expense. So whenever you see the word prepaid, I want you to think that is an asset, and then I credit cash. So one asset goes up and another asset goes down. Okay, so prepaid goes up, cash goes down, total assets are the same. Okay, you can kind of see the effect in the accounting equation down here. You can see right here that one asset goes down, we credit cash, we debit prepaid expense, which is the other asset that goes up. Liabilities and equity were not affected. And so due to the passage of time, that prepaid expense will expire. And so when we get to the end of an accounting period, we need to make an adjustment for that. Okay. And so it says that prepaid account expenses decreased for the amount of the prepaid expense that's expired has been used and related expense account is increased. So the asset goes down and the expense goes up. So we could prepay for rent or prepay for insurance, and then through the passage of time, the prepaid asset goes down and the expense increases. Okay, so you can see we reduced expense, and then we also, we reduced the asset, I should say. We credited prepaid asset, and we debited expense, which makes equity go down. So asset goes down, and equity goes down in an equal number. Another type of adjusting entry is called unearned revenue. It says the advanced receipt of future revenues and are recorded as liabilities when cash is received. Okay, I can give you a really good example of that. I have a company, I've been in my house for 15 years. We bought it brand new, but with no yard. So basically we had a very nice house and no landscaping and no yard. And so of course that was part of the process to move in. So I hired a company to seed my yard for me and turn it into grass. And for a fee then, every year they've come out and they do my fertilizing, and they do pest removal. They will spruce up my landscaping. They'll root feed the trees. Whatever I want them to do, they'll do it. And they send me about this time of year, every year actually, a brochure that says, here's what we can do, and here's what our pricing is. And if I pay them before April 1st, I can take 5% off. Okay, so I almost always do that. I guess why not save at least 5%? So I'll send them my money here pretty soon, and they're going to receive from me payment in advance. Okay, and so I'm going to pay them for things they'll do in the future. So sometime in April they'll come out and they'll start to do their fertilizing, they'll do pest control, all those things. They'll do it throughout the season and probably be done sometime in October. Okay, so basically I'm going to pay them now for work they'll do for me between April and October. Okay, so they're going to get my money. Obviously they're going to cash that check, and that's the whole reason they're giving me a discount now is they've got cash flow now, right? So now they're getting money as they begin to get geared up for the season and incur expenses. Now they've got some cash to use to do that, and now they just owe me the delivery of a service. Okay, and so that's an unearned revenue because they have not earned it yet. So whenever you see the word unearned, I want you to think liability. Okay, so I'm going to debit cash. If I'm the business and I'm receiving payment in advance, so I've not yet delivered anything to the customer, but the customer paid me. I'm going to debit cash. Obviously, I'm going to put that money in the bank, right? I'm definitely going to do that. It's just that I can't credit revenue because I haven't done my part, which is to deliver a good or service. And so I'm going to debit cash and credit unearned revenue, which is a liability account. So asset goes up and liability goes up. And then at some point in time, of course, I'm going to begin to deliver services or goods to the customer. And so as I do that, I would then debit unearned revenue. I'd reduce the liability, and I would credit revenue. So I'm going to turn that liability into revenue. Okay. Magazine subscriptions are another good example of this. If you buy a magazine subscription for a year at a time or 2 years at a time, they can't call that revenue until deliver a magazine to you. So every month when you receive a new magazine, that company now can record a portion of that as revenue. Okay, so that's basically turn liability into revenue. Another one's called accrued revenues. It says unrecorded revenues that have been earned and for which cash has yet to be received. Okay, so we do something for somebody, we deliver a good or service. They don't pay us now, but they pay us in the future. That's an accrued revenue. Okay, so it says here, revenues has been earned but has not yet been recorded. Revenues have been earned, but the revenue has not been recorded, nor has cash been received. It says no journal entry has been recorded, even though revenues have been earned. Okay. So that lets me get to accrued revenue. So with an accrued revenue, it says at the end of a period, we need to make an adjustment to record accrued revenue. Okay, so basically what happens in this first transaction is we didn't actually book anything yet. It says revenues have been earned, but the revenue has not yet been recorded, nor has cash been received. Okay, and so we've earned a revenue, but we didn't record anything yet. And so we get to the end of the month, or whenever the accounting period is, and we make this entry right here. It says an asset account is increased or debited for the amount of revenue that's been earned, and the related revenue account is then increased, and then we have some kind of a receivable account. Typically, account receivable, possibly fees receivable, something like that. Okay, some receivable that says somebody owes me money. Okay, so let's just say it was worked like this. Let's just say I have this lawn maintenance company, and I don't prepay them, but I basically say, yeah, come and fertilize my lawn, do the pest control, root feed my trees, do the fertilization of my landscaping and those things for me, and just bill me every time you do it. Okay, I could definitely arrange that with them. They'd be just fine with that. So they do that, they'd bill me, and that would then be an account receivable, right? So if they come to my house on, let's just say, April 30th, and do all those things and then bill me, they've earned the revenue on April 30th. They did what I asked them to do. And then they will bill me and then have a receivable. They'll make this entry that you see on the screen, and I owe them now whatever they charged me to do that. Types of an accrued expense is an unrecorded expense that has been incurred, but yet cash has not been paid yet. So quite often you incur an expense first, and then you pay for it in the future. Okay, so an expense has been incurred, but we have yet to record anything to show that. And so what happens then is we get to the end of the accounting period and we realize that we've incurred a particular expense and it's time to pay it. Okay, so let's just say for this lawn maintenance company, they've been operating all month. They've got a shop where they store all their equipment and keep supplies and stuff like that. And obviously that shop would need utilities, light, electricity, natural gas, water, and so on. And every month they're using that shop and incurring utilities, they'd have to record some kind of expense. But the way it usually works with utilities is you use them first and you get billed based on volume later, right? So let's just pick the month of April. So for the month of April, they were using the shop and incurring utility expense, but they don't know what that dollar amount is until they get the bill sometime in early May. Okay, but we get to the end of the accounting period and we know that, yeah, we we definitely used the shop, we incurred utilities, so I have to record something for that. Okay, so there's lots of expenses or examples of accrued expenses. You name any kind of expense, and we could have an accrued expense. So any expense that you could incur up front, but you pay for later. So interest, wages, any kind of expense you can think of, you potentially would have to accrue for. Let's talk about then entries for accounts requiring adjustment. Okay. And so here we have the sample company that we use in the book called Net Solutions. And you can see here we have an unadjusted trial balance. So unadjusted means I do an accounting period. It says here December 31, 2013. I've gone through a full year, did all of my accounting, and my accounting balances, because my debits equals my credits, which you definitely want to make sure before you do your adjusting entries. And then I do my adjusting entries, and then I have an adjusted trial balance after that. You can see here I have a chart of accounts. In the purple colors here, I've added some new types of accounts that I'm going to use for my adjusting entries. Keep in mind that the chart of accounts is organized by the accounting equation. Typically, a 1 means an asset, a 2 a liability, and so on. So we've added a few new accounts. And so prepaid expenses then. Here's an example of a prepaid expense. So it says that Net Solutions supplies account has a balance of $2,000 on the unadjusted trial balance, but we know we've used some supplies since last time. And so we do account. We go and we to the supply room, we do account, and we figure out how much supplies do we have on hand. And the answer is we have $760 on hand. We had $2,000, now it's $760, so the difference of $1,240 is what we've used. And that requires an adjustment because we need to get from $2,000 down to $760. So I make a journal entry. The difference is $1,240, and we'll debit supply expense and credit supplies to show that we've used up some supplies and turn them into expenses. Okay, so asset goes down, supplies goes down, and then expenses go up, which means equity is going to go down. Okay. So that's our journal entry, is to record asset turning into expense. Another example of that is prepaid insurance. You can see here the debit balance of $2,400 in Net Solutions prepaid insurance account represents the December 1 prepayment of insurance for 12 months. Okay, so on December 1 they wrote a check for $2,400 which covered 12 months worth of insurance. So after 1 month goes by, the month of December, they've used up 1/12 of that balance. Okay, so obviously $2,400 divided by 12 is $200 per month. So at the rate of $200 per month, that prepaid asset will turn into expense. And we can make the entry that you see here to debit expense and to credit prepaid insurance, which is the asset. So basically, asset turns into expense. Okay, and so it says here the impact of omitting an adjusting entry. What happens if we omit that? Basically means we're going to have a not correct set of financial statements. We'll just say it that way. We'll end up recording the expense or the revenue in the wrong accounting period, and that's going to mean that whatever accounting period that we present, December 31 of 2013, is going to be wrong. And so this 1,440, basically if we don't do the adjusting entries, expenses will be understated, and then assets will be overstated, and equity will be overstated by 1,440. Unearned premiums or unearned revenue is the next one. So it says the credit balance of $360 in Net Solutions unearned rent account represents receipt for 3 months of rent on December 1. That was good for December, January, and February. At the end of the month, 1 month's rent has been earned. Okay, so they have a tenant, somebody prepaid them for 3 months of rent on December 1. So after 1 month has gone by, they've earned 1/3 of that $360. So obviously that's $120. So they can call that revenue now. So they can debit unearned rent, reduce the liability, and credit the rent revenue account, both for 120. And you can see that if we don't do that, we will understate revenues by 120, which means we'll understate net income, and then liabilities will be too high and equity will be too low, both by 120. Accrued revenues. Net Solutions signed an agreement with Danker Company on December 15 to provide services at the rate of $20 per hour. As of December 31, Net Solutions had provided 25 hours of services. The revenue will be billed on January 15th. Okay, so basically for 2 weeks, Net Solutions delivered 25 hours worth of services and should be charging them $20, but they're only going to bill them monthly on the 15th of the month. And so December 31 comes by. We've earned some revenues, we just haven't recorded anything yet because we're going to bill them in January. So we need to make an adjusting entry to say, hey, we've earned some revenue, even if we haven't received the cash yet. We did the work, we did what the customer wanted us to do, therefore let's call it revenue. And so we'll debit account receivable, we'll credit fees earned, both for $500, which is the 20 times 25. And you can see what the entries are down here, how they posted them to the T accounts. You can see what would happen then if we omit that. If we omit that, revenues would be understated and then net income would be overstated. Next is accrued wages. So accrued expenses, accrued wages. You can see here we've got the month of December and a little bit of January. And it says in green there, when we've been paying wages, it said paid wages expense for December 2nd through the 13th. We paid on a Friday, the 13th, and then we had wages expense from the 16th through the 27th. And we paid wages expense on the 27th for 2 weeks. But then we had 2 more days in December where employees were working for us. On Monday and Tuesday, the 30th and 31st, we had employees working for us. But because we pay every 2 weeks, those employees will not get paid until January 10th. Okay, so employees worked for us for 2 days in December and then 8 days in January, but we're paying them in January. Okay, but when I stop on December 31st to do my financial statements, I have to stop and recognize the fact that I got to record an entry for 2 days worth of expenses in December that won't get paid until January. Okay, that's an accrued wage. There's all kinds of examples of accrued expenses. So it says that they're paying their employees bi-weekly, every other week. And so during December, they paid wages of $950 on December 13th and $1,200 on the 27th. And then as of December 31st, they owed $250 of wages to employees for that 2 days, for the Monday and Tuesday, the 30th and 31st. So we have to make a journal entry to record the fact that we owe our employees some money that we'll pay them for in January. And so we'll debit wage expense and credit wages payable. And so the way an accrued expense entry works is you debit expense and you credit payable. And so you can see here, that's just simply what the entry was to record this. So liability goes up and expenses goes up, which makes equity go down. And then it says when they actually pay the full amount to employees in January, so on January 10th they'll pay for the previous 2 weeks, they credit cash for $1,275, but they only debit wages expense for $1,025, which is basically the wage expense from January 1 and January 10, because the previous $250 was already recorded as expense in a previous month, and so we'll debit wage payable to remove the liability. So whenever you pay off a liability, you give it a debit. So the impact of omitting this adjusting entry, we'd be understating expenses, we would be understating liabilities, and overstating equity. Depreciation is one we have not yet talked about. Depreciation relates to long-term fixed assets. Another word for that is plant assets. So basically physical resources, things that we can look at, see, and touch that have a fairly permanent life or a long-lasting life. So something as simple as a building, a vehicle, machinery, equipment, things that a business acquires that will last a long time. And because they last a long time, we have to allocate their use to the accounting period they're used in through the process of depreciation. That's basically allocating cost to expense as we use the asset. Okay, that's what that means. So all fixed assets except land lose their usefulness and they're said to depreciate. So the only asset we don't depreciate is land. So as a fixed asset depreciates, a portion of its cost is recorded to expense, simply just called depreciation expense. So the fixed asset account's not increased when making the related adjusting entry. It's because both the original cost of the fixed asset and the depreciation recorded since the purchase are reported on the balance sheet. Okay, instead we use an account called accumulated depreciation, which is called a contra account. Okay, so there's all kinds of contra accounts. We'll learn about some more later on. This is the first one we talk about. And so whenever you think contra, I want you to think opposite. And so contra asset means we're opposite to assets. Okay, so assets have a debit balance. Therefore, a contra asset would have a credit balance. Okay, the opposite balance of asset. And so we are going to debit expense and credit the account called accumulated depreciation. So we hold all depreciation in this contra account instead of just crediting the asset account directly. This is normal titles for fixed asset accounts and their related contra asset accounts are as follows. We've got some coming up here. I put that in presentation mode. There we go. So you got a few right here. Let me put that in this mode so you can see this a little bit better. Remember that land is not depreciated. Okay, it's the one we don't depreciate. Buildings we do depreciate. Store equipment, office equipment. So it's pretty simple. If I've got building, I need to have accumulated depreciation building. If I have store equipment, I need to have an offsetting accumulated depreciation account. Okay, that's just how those work. So they're going to estimate that depreciation would be $50 a month for December. Now at this point in time, we're really not learning necessarily how we compute the depreciation. We'll do that in a later chapter. But just know for this chapter, they'll give us the dollar amount and we just have to book an entry. So we're basically saying here's what depreciation should be on the equipment. So we'll debit expense and we'll credit accumulated depreciation. You can see how we post that into the T accounts. So we never post that depreciation to the asset. Instead, it goes to the contra asset. Okay. So the difference between original cost and all depreciation taken is called book value. So cost minus depreciation equals the book value of an asset. Okay. You want to make sure you want to know that. Okay, they're just basically saying equipment's cost was $1,800. Depreciation taken so far is $50. Therefore, book value is $1,750. If we were to omit this entry, expenses would be understated, too low. Therefore, net income would be overstated. Therefore, the balance sheet would be overstated. Therefore, equity would be overstated. So that there is a consequence in not recording that. Okay. So let's summarize the adjustment process. So here's a good one-stop shop that shows you all of the different types of adjusting entries. Okay. So prepaid expenses, then you can see it says for supplies, prepaid insurance, rent even. Basically those prepaids, they get used up, right? As we use them up and transfer the asset into expense. You can see some examples we looked at. You can see how it impacts the financial statements. So that's just kind of what we're going to go through here is look at each one that we did and why we do it, what the journal entry is, and then how it impacts the financial statements. So remember, unearned revenues is basically a customer prepays us. You know, subscriptions are a really good example of that one. You can see what those entries are. accrued revenues. We've earned a revenue. We've delivered goods or services to a customer. We just haven't billed them yet. So we get to the end of the month and we've done some work for a customer but have never billed them. And so we make this entry just to make sure we record those revenues in the proper accounting period. Same thing with accrued expenses. We've incurred an expense that we haven't paid for yet. Salaries is an example, interest is an example. Any kind of expense you can think of potentially would fall into this category. Depreciation is just simply allocating the cost of a fixed asset to the period where we use it, using some kind of systematic method. Okay, to do that, you can see what the entries are. In this chapter, they're going to give us the dollars amount when you do a problem. When we get to a future chapter, we'll actually compute how you get to that dollar amount. Okay, and of course, all of the adjusting entries must be journalized in the general journal. You can just see what we've done here to do that. And of course, they have to be posted from the journal to the ledger. And so you can see I've got depreciation down here in the bottom right. You can see it in blue, the new entry there. You can see some other postings in various accounts also. And some more there, and some more there. Okay, so once we've got all of the adjusting entries identified, journalized, and posted, we can then do what they call the adjusted trial balance. Okay, and of course we're trying to make sure that debits and credits still equal before we actually prepare financial statements. Okay, so here is a list of, in black was the original trial balance, and now in blue is my adjusted trial balance with the new accounts. Okay, and finally we can use some analysis to help us understand financial statements a little bit better. And so vertical analysis is one potential way. It says to compare the amounts from the same statement is called vertical analysis. Okay, and so typically when we do this with an income statement, we basically compare everything to the revenue number. And so in this example, it's for a law firm, so we have fees earned, and you can see here they're earning fees from providing attorney services to customers. And we take every line of the income statement and divide it by revenues. Okay, so 187.5 divided by 187.5 is 100%. 60,000 divided by 187.5 is 32%, and so on. So just keep doing that, and that's how you get your percentages on the right-hand side. So this is doing a vertical analysis. The reason we do that is we can kind of do a comparison of expenses from one year to the next. I can go, wage expense went up by 15,000. Which might make sense because we had more revenues, but now I realize that this wage expense is 32% of revenues, whereas last year was 30% of revenues. So why did that go up? Did we give our people a raise, or what caused that to happen? Same with utilities expense. It was 6% of revenues, now it's 6.7%. What made that go up? So those are the kind of questions that maybe you can ask that you wouldn't have figured out if you just looked at the numbers by themselves. The percent of increase, without knowing the percent of increase, it's harder to understand, did that number going up make sense? Because I've got more revenue, so I should have more wages. It makes sense to have more utilities, but if the rate of change is different than what it has been in the previous years, that should have me ask questions to figure out why that's happening. Okay, so we're just simply dividing every line item by revenues to get to our percents. That's all that they're showing us there. You can see they do the same thing right here. Okay, so that's the adjusting process. In the course, in the handout section, there's some information there that deals with adjusting entries. You should definitely take a look at that too. And as always, if you have questions, just feel free to let me know.